Floating rate bank loan funds sound like they might be an esoteric asset class, but they're really not. They're just another category of bond fund. And over the last 20 years, they've only had one down year, and that was 2008. And yet investors continue to pull money from them. What are they missing? What are the misperceptions out there? Kevin Gundersen from Guggenheim is going to answer that question, and he's going to tell us how these funds might perform in a rising rate environment.
Floating rate mutual funds have performed very well. If you think about the underlying assets, bank loans, they've had positive returns for approximately the last 20 years with the exception of 2008. Over the last 10 years have returned close to 5%. Bank loan coupons continue to be in that 4.5% to 5.5% zip code, which we think is a decent proxy for what the return profile will look like in the near term. The coupons are floating rate, which means on a quarterly basis they reset and they rise with a rising interest rate environment, which is one of the interesting things about the asset class is that it provides some protection in a rising rate environment. What I think investors are missing is that the asset class provides very good protection against two of the key risks that I see out there in the environment today. One is economic risk or credit risk, and the other one is interest rate risk. And so we talked a little bit about the interest rate risk. On the credit risk side, bank loans are the top of the capital structure, which means they're the first in right of repayment. So they're the least risky piece of capital in a capital structure, so safer than subordinated bonds or equity. They're secured by the assets of the company. You have a credit agreement or a document which lays out what the company can and can't do, so additional protections that protect the investor. In addition to that, they're a pretty stable, predictable source of income. So that's what I think the market's missing. As far as misconceptions, potentially there's some misconceptions around the risk of bank debt. So they're obscure companies that people have never heard of, when in reality companies like American Airlines, Hilton, Burger King all issue bank debt. So these are not necessarily companies you never heard of, and if you haven't heard of them, oftentimes it's because they do things that you don't realize they do. So First Data is a company that every time you swipe your credit card, 50% of the time they're doing the processing in the background. So they're companies that deserve to exist first and foremost. And in addition, you're the top of the capital structure. So even if that company is not worth as much tomorrow as it is today, you have a buffer between what the company is worth and what your position within the capital structure is. One of the things we're focused on as far as managing our floating rate fund is the liquidity profile of the underlying assets, the bank loans, versus the liquidity profile that investors have that invest in the mutual funds. So for instance, when I buy a bank loan, it takes almost 15 days to settle that. Similarly, if I sell a bank loan, it takes me 15 days to actually get cash in the door, versus investors have a much shorter liquidity profile. And so that mismatch is something that we're concerned about, particularly as the popularity of mutual funds have grown over time and they represent a bigger portion of the market. We're laser focused on that. So one of the things we've done and talked to investors about is focused on liquidity. So liquidity of the underlying loans, we focus on larger companies, Hilton, American Airlines, Burger King, versus smaller middle market companies that have less liquid debt. So if it's a $3 billion loan, it's much more liquid than a $300 million loan. That's one thing. Second thing is we carry today about 10% cash. We've carried an elevated amount of cash over the last couple of years as this concern has, as we've been concerned about this potential risk. We also have some high yield securities, some high yield bonds in the portfolio, again for a liquidity buffer, which those tend to settle as quickly as 1 to 2 days versus 15 days for bank debt. Then we also have some ABS securities that settle in a much shorter time frame. So up to 25, almost 30% of the portfolio today, including cash, is held in much more liquid securities, which gives us a liquidity buffer. We also have a liquidity line, but we think of that as the last resort, and so we want to create other liquidity buffers before we have to tap that liquidity line.